How are you now? Broadcasting from the VFS studios in Sydney. You are listening to the all-new Pip Show, Season 5, Episode 14. Don't forget to hit subscribe and rate us wherever you get your podcasts. And a reminder that all the financial information in this podcast is general in nature only. Speak to a professional advisor about your needs. Speaking of which, I am a professional advisor. Sometimes people have called me that. James Whelan, Investment Manager of VFS Group. Paul Colgan is back from Davos. He took a cab to another wrong place. We're hoping he's going to be here by next week again. This episode is being recorded in Sydney. It's 10:08 in the morning. I have not checked in on the market yet because I'm doing this. It's the 21st of October 2022 AD. Today's guest is ANZ senior economist, long-term friend of the show. We fell in love with her when she got on and just blew us away. It was a couple of years ago. Adelaide Timbrell. And we always love to pick her brain because she's one of the smartest people in finance, if not just in all things ever. I've given you a good rap, Adelaide. Hope you earn it.
Yeah, pressure's on. Thanks for having me.
No problem at all. Yeah, really good of you to come on. Now, there's a lot of stuff that's going on in Australian financial markets, as there always a lot of stuff going on. RBA slowed itself down a little bit with that 25. The minutes came out saying why they slowed things down, because they wanted to sort of extend it a bit longer. So look, today in the show, we're going to talk about those minutes. We're going to talk about discretionary spending, rate expectations, household finances, confidence, and also with the budget coming in next week, if we've got time to get to that too. So look, I want to try and keep it to 20 minutes. So Adelaide, the budget, the RBA minutes, what did you take out of it? And what should people be taking out of it? Was there much relevance to the common man in the street?
Look, I think what we saw in the minutes was that it was a real debate between 25 basis points and 50 basis points for the last hike. It did come out as 25 basis points in the end, but I think what it's showing us is that the Reserve Bank has decided through its October rate hike that we're no longer in this really rapid mode of going, oh, we've got to get out of emergency stimulus, we've got to get things back on track as quickly as possible. Now I think they're in more of a refinement mode where it's like, we know we've got to keep doing these rate hikes. We know people are still spending. We know inflation, even inflation that's locally sourced within Australia, is still too high, but we don't want to keep going at that really rapid pace. And so what that means is that next time we see a rate hike, which we think will happen in November, we'll probably see another 25, even if the CPI data that comes out next week
on the 26th.
Is actually really strong.
Yeah, that's. I'm seeing predictions of that as well. Where are you expecting CPI to sit?
We're expecting to see 7% year on year for headline inflation. So that's the inflation you hear on the news. Yep. And then 5.6% for the trimmed mean inflation, which is more relevant for the Reserve Bank. But I mean, these are really big numbers.
They are big
and
numbers.
The Reserve Bank's thinking similarly. Like they think that, inflation will peak at 7.75% at the end of the year. Treasury's thinking on very similar terms, but they're still going to be going on those 25 basis point hikes. Another thing that they're saying, which I thought was really interesting, is that they want to keep public attention on the rate hikes. They want households to keep feeling the pain of these little squeezes on the household budget every month or every couple of months so that they'll be thinking more about slowing down spending. I think this is a management around inflation expectations. So rather than doing a big one and going, oh, people will think that's it and kind of stop worrying about it and assuming inflation will come back down, they may accidentally then contribute to longer term inflation by spending more money thinking that the pain is over.
Yeah, the Batuta did a very funny story the other day with Governor Lowe standing in Woolies yelling at people for having too much junk in their baskets as they were checking out of the shops. That's the message. The messaging, I have to point out the irony that is involved in the RBA that under-delivered the communication with regards to rate hikes, now overcompensating with regards to actual rate hikes.
Absolutely. I think, when we look at the Reserve Bank, they did start their rate hikes a lot later than places like New Zealand and other countries around the world. There was tightening of monetary policy before that. They took away all of their unconventional measures, but they've gone from really jawboning that, we're not going to raise rates till 2024. And now they're saying, actually, we want to be raising rates pretty much every month so that people are thinking about it and slowing things down. It's a very, very big change in approach.
I can assure you, if I wasn't talking about this every week, I would absolutely be thinking about this anyway. And I don't know anyone else that isn't thinking about it. So how much thinking about it do we have to do before it actually converts to decreasing in spending? And what are you seeing in that context with regards to what people are spending money on that they probably shouldn't need to or don't need to, i.e. the discretionary side of the world?
Absolutely. So we're seeing a huge boom in discretionary spending growth at the moment.
People, come on.
There's this myth that inflation and higher interest rates are eroding savings and really creating a pullback in consumer spending. But that's not actually in the data. The data is showing us nothing really big is happening on a pullback of consumption. We're seeing in our ANZ spending data that people are really not moving their spending backwards at all. And we dig into the discretionary side of things to see, oh, well, maybe people are spending more on groceries and spending less on the fun stuff. But that's not even the case. In fact, one of my favorite subcategories of spending is travel agent spending, because it's something where as it's going up, you know that means that person's actually going to plan to spend 5-10 times more once they hit that big overseas trip, because you're not going into a travel agent for a cheap and cheerful weekend away. Nobody's going in there to kind of book a camping spot somewhere. You're kind of going in there for the big stuff. And I think if the average person was really worried about their financial condition, we wouldn't see travel agent spending actually back at pre-COVID levels. We would see a pullback in furniture spending as well, because that's kind of the first thing that you go, oh, maybe I shouldn't buy a new couch right now.
Yeah.
Things might be getting a bit tight, and we're seeing absolutely no slowdown there. And of course, dining and takeaway has been on a huge boom all through the year in both nominal terms, so the dollars that we're spending, but also volume terms, so the amount that we're eating out. And I think anyone who's tried to get a spot at a restaurant in the major capitals in Australia will probably know that instinctively as well. So we're still going out for dinner, we're still spending money. The slowdown will happen. You know, interest rates are going to make it such that people went from spending 5% on average of their post-tax income on interest payments to around 11%. It's going to be a slowdown, but we think it's a next year problem.
Yeah, I have a tendency to agree with you, and I still stand by the fact, especially with retail stuff, that it'll be Christmas is sort of the last big hurrah. Kids, these are the last big gifts that you're going to get for a while, because we're going to have to tighten everything up. I'm thinking about, everyone standing in those packed bars and sitting in those packed restaurants, and the only thing they're talking about is how much those rate rises are hurting their spending. Get out of the restaurants, people, otherwise they're going to keep on raising rates on us. Now, so household finances, you talked about how much people are spending on interest. That's great. What about confidence in the economy? I know that you wanted to touch on that.
Yeah, so look, people are in for that shock of going from 5 to 11, and that's trough to peak too. So that hasn't quite fully happened yet. And what we're seeing is that confidence among the household sector is extremely low. We're really seeing confidence prints that are looking quite similar to that first month or so of COVID, where we were hoarding toilet paper, JobKeeper didn't exist yet, and the forecasters were saying that unemployment would reach double digits because, without some of that government intervention, that would have actually happened. So, we're seeing very similar confidence levels now, even though unemployment is at a 50-year low. Even though there's so much job switching that household average earnings per hour are double the wage price index. So, inflation was 6% year on year to the middle of this year, and average earnings per hour were up 5%. So we're actually only down, that one kind of percentage point gap in terms of our real buying power. No one's expecting to lose their job and not be able to find another one. We've seen a lot of people get capital gains from a really hot housing market, and even the housing reductions that we're expecting in prices will only shave off 2021. They're certainly not shaving off any capital gains growth before that, and yet people are really, really upset. So it's interesting that spending is really solid, but consumer confidence is down. And it's the same in businesses. When you ask a business about the economy, they are really pessimistic. But when you ask a business about what they're doing, how their demand is going, they're actually more optimistic. So people know, I think, that demand is solid within their own industry or within their own market share in business. But if they think about that abstract concept of the economy, we're really not feeling confident at all.
That's extraordinary. So just these mixed messages that are coming out from different parts of the market. It is thinking about, I mean, that was an off the cuff joke, but yes, the packed restaurants are people talking about how bad the economy is.
It's true, yeah. There's this real mismatch in expectations, and I think if you are looking at consumer confidence or business confidence measures as a leading indicator of actual spending, it's really weakly correlated right now. I mean, it was never really strongly correlated before, but it's never been less useful as a leading indicator. In fact, private capital expenditure estimates are incredibly strong. People are looking forward at inflation, at a slowdown in the economy, and they're still saying, you know what, it's still actually going to be worth me investing and expanding at least a little bit.
Yeah, and that's not such a bad thing. I mean, that needs to keep on going, and this is sort of the difficult game that the RBA has got to try and navigate, of talking it down, getting people to spend less, without breaking everything in half, which is entirely possible that it could do. And I mean, it's a job that I don't want to have. I know that you could do it in a heartbeat, but it's a job that I just wouldn't even want to touch it with a barge pole, Adelaide. And we've often talked about, sort of half jokingly, about what you would do if you were head of the RBA one day. How would you actually be? This unplanned question. How would you be navigating 2023?
I think it's a really tough situation right now. We've got to remember that the Reserve Bank, their responsibility is total inflation at 2 to 3%. But what they have control over is only locally sourced inflation. You can't make petrol cheap by the tiny country of Australia, 25 million of us, 7 billion people in the world, by making us spend less money. You're not gonna shift those commodity prices in a meaningful way. So we've got authority over only locally sourced inflation, but responsibility over all that, kind of the average of all types of inflation. So what the Reserve Bank has to look at now, a lot more than they have before, is what's that global volatility going to be doing, and how much do we have to offset that high inflation now with lower household demand within Australia? Right now, both measures are too high, but depending on where global inflation is going to be, we may not have to work quite as hard to get demand in Australia down. I think too, the fixed rates are a really big issue that they're going to create a step down. The penny's going to drop for a lot of people between, April and November next year. A lot of people are living in a monetary policy situation of 2020. If you're on a fixed rate of 2%, you're living in 2020 when it comes to monetary policy, which means you're spending as if the Reserve Bank is encouraging you to spend, even though right now, as they're moving those rates up, they're actually trying to encourage you to save. So we're going to see a lot of that concentrated into a 2023 slowdown. And I think the Reserve Bank's really scared of overcooking the results. I think a 3.6% cash rate, which is the ANZ forecast for the peak mid next year, is most likely to be appropriate. But if households keep spending money, they may be forced to go a little bit higher than that. If they're forced to go higher than that, the risk of recession gets a lot higher as well. But just like in other countries, a recession's actually not going to be as damaging as long-term inflation. If your groceries are going up 20% a year, 10% a year, 8% a year, you probably wouldn't have minded, a few people being out of a job for 6 months in order to make, so that everyone actually isn't going to be poor forever, essentially.
That's cool. No, and I do understand that. All right, now finally, or almost finally, budget next week. Anything predicted out of that, or things that we may be needing to be looking at?
Look, I think that the budget this time around, Chalmers has said it's going to be boring. He's saying the windfall of the last financial year budget won't be repeated. Although, we don't think that the budget deficit for this current financial year will be all that much worse than last year. So last year it was supposed to be like $100 billion deficit. It ended up being about $30 billion. Oh, sorry, maybe 80 to 30. Anyway, it was supposed to be terrible and ended up being kind of okay. We look forward and go, there's a lot of expense pressures happening. Health, NDIS, defence, aged care and interest payments on all of that debt are going to keep those budgets in deficit going forward. It's really just a question of how much. I think the new government will be really careful to put anything really big and new in there, especially things like infrastructure, because we're already crowding out private sector investment on that side of things. Parental leave's not going to be inflationary. Childcare is not going to be inflationary either. Even though it puts more money in people's pockets, it also puts more people in the labour market, which means there's less of a labour shortage and there's more ability to actually create some stability in terms of that labour supply and demand mix.
Good work. Okay. Well, look, with nothing else to go through, I'll just keep it nice and quick and clean like this, unless you want to get into something else, Adelaide. MMA?
No. I mean, let's not. Oh, actually, there is one thing I do want to say just really quickly. If you're working in finance like you and I are, James, or even if you're listening to this podcast, you've got to remember you're probably going to be more financially literate and thinking about your interest rates a lot more than the average person in Australia. So if you're thinking, oh, I know my fixed rate's going to roll off, I'm going to save a lot of money before then, surely everyone's doing that and we'll see a spending slowdown. That's really not going to be the case. For most people, they're going to have to be forced to stop spending that money in order to get that done, because we just don't have a high level of financial literacy in Australia. And that's something that does, I think, really profoundly impact the transmission of monetary policy. It's not about maths. It's not about being rational. It's about if people can spend and have the savings, they'll just spend and spend and spend until something actually gets really bad.
That's what I've been doing. So, the level of my financial literacy isn't exactly the benchmark that everyone should be resting upon either. But that's why I have people like you on. Adelaide, I'm going to wrap it up now. Thanks very much for joining us. Unless there's something else you wanted to mention?
No, I'm all good. I've said my little piece. Thank you so much for having me.
Not a problem at all. You can find us on iTunes at The BIP Show or wherever you get your podcasts. We're on Twitter as well, Facebook. Check out Whelan Capital. Google that. It's where I put all of this. I'm going to put some notes on, provided you actually send me some notes, Adelaide. I don't know if you've got the ANZ note. I'll put it on the website as well and link it up to you as well. Individually, I'm on James Whelan 42 is my Twitter handle. And Adelaide, I think you're just Adelaide_Timbrell, aren't you?
Just Adelaide Timbrell, one word. Yeah.
Yep, Adelaide Timbrell, one word. The show is produced by Chad Powers, and we'll catch you next time. Thank you so much, Adelaide, for joining us.
Thank you. See ya.
See you guys.